$4.8 billion disappeared in just a few weeks. The person who lost it wasn't careless. He wasn't uninformed. In fact, he had won a Nobel Prize for his work on financial markets. Meanwhile, hundreds of miles away, another investor was quietly becoming richer than almost anyone on Earth. His strategy? Buying ordinary businesses, ignoring the noise, and taking plenty of naps. Same markets. Same era. One nearly dragged the global financial system into chaos. The other built one of the greatest fortunes in history. This isn't a story about intelligence. Because when it comes to investing, the smartest person in the room often loses. Instead, this is a story about 12 costly mistakes that destroy wealth generation after generation, and the 12 mistakes Warren Buffett spent decades avoiding. I'm Della, and I've spent an unreasonable amount of time studying why brilliant people keep making disastrous money decisions, while one patient investor from Omaha keeps winning without breaking a sweat. If you've ever looked at your investment account and wondered whether you're doing something wrong, stick around. Because today we're breaking down the 12 investing mistakes Buffett has warned about for decades, and exactly how much each one can cost. Before we start, remember one idea. Every mistake on this list comes from the same source. Trying to be smarter than the market instead of more patient than it. I call it the genius tax. And the cruel part? The smarter you feel while paying it, the more expensive it becomes. Buffett said it best. The most important quality for an investor is temperament, not intellect. Everything we're about to discuss is simply a different way of forgetting that lesson. Meet Mason. He's 35, follows financial news every day, and considers himself a reasonably smart investor. Over the next hour, Mason will make nearly every mistake on this list. Not because he's foolish. Because he's human. And human beings are expensive. One more thing. I'll reveal the identities of the two investors from the opening story later. And the most expensive mistake on this list? It's also the most boring. There's a good chance you're making it right now without realizing it. Quick disclaimer, I'm not a financial advisor. This is educational content based on research, experience, and observation. Let's begin. Mistake 1, trying to time the market. Everyone has dreamed about it. Buy at the bottom. Sell at the top. Avoid crashes. Catch every rally. Sounds brilliant. The problem? It assumes you can predict the future. And nobody can. Buffett once joked that stock forecasters exist mainly to make fortune tellers look respectable. Think about that. One of the greatest investors ever openly mocked market predictions. Even during the 2008 financial crisis, Buffett admitted he had no clue where stocks would be a month or a year later. Why? Because markets don't move in straight lines. Most long-term gains come from a surprisingly small number of explosive days. Miss those days and your results collapse. Imagine investing $10,000 for 2 decades. Leave it alone and it grows to roughly $68,000. Miss only the 10 best days during that period and suddenly you're sitting closer to $31,000. Half the outcome disappears. What's even crazier? Many of the best days happen immediately after some of the worst ones. The moment investors panic and sell is often the exact moment recovery begins. Yet every crash creates the same temptation. Mason felt it in 2020. Markets were collapsing. Headlines were terrifying. His portfolio looked awful. So he sold everything and moved to cash. His plan sounded responsible. Wait until things settle down. Then buy back in. A month later, markets had already surged upward. Mason missed the rebound. The patient investors didn't. That's why time in the market beats timing the market. Not because it sounds catchy. Because the biggest opportunities are usually hidden inside the scariest moments. The days you're absent are often the days that matter most. Mistake 2, paying high fees. There's a hidden expense quietly draining many portfolios right now. Most people never notice it. No invoice arrives. No notification pops up. No warning appears. Yet over decades it can steal hundreds of thousands of dollars. Buffett has always been blunt about fees. When trillions of dollars are managed by professionals charging high costs, he says, it's usually the managers who get rich, not the clients. Let's see why. Suppose you invest $100,000 for 30 years and earn 7% annually before expenses. With almost no fees, you finish near $770,000. Add a 1% annual fee and the ending value drops to roughly $580,000. Raise that fee to 2%, and you're closer to $440,000. That tiny percentage just cost you over $330,000. Imagine a silent roommate living in your house. They don't contribute. They don't help. They simply take a portion of everything you earn. Year after year. That's what high fees do. Buffett proved this publicly. In 2007, he challenged a group of elite hedge funds. His bet was simple. A low-cost S&P 500 index fund would outperform them over the next decade. The hedge funds had armies of analysts, sophisticated models, and enormous resources. The index fund did almost nothing. Years later, Buffett won by a landslide. The simple index fund crushed the expensive professionals. Why? Because costs matter. Every dollar paid in fees is a dollar that can no longer compound. And compounding is where wealth is created. A fee is guaranteed. Superior performance is not. Never exchange certainty for a promise. Mistake 3. Letting fear and greed take control. Studies consistently show that active traders underperform the market. Not because they're unintelligent. Because emotions make terrible investment advisors. People buy when excitement peaks. They sell when fear peaks. Exactly backwards. Every time investors panic, greed or fear is usually sitting behind the wheel. Mason checks his investing app dozens of times per day. Every market movement feels urgent. Every headline feels important. Every dip feels dangerous. Every rally feels like an opportunity. The constant activity creates the illusion of control. In reality, it's often just expensive entertainment. The hardest investing skill isn't analysis. It's staying calm. Mistake 4. Overtrading. Many investors believe more action produces better results. Usually it produces more mistakes. Every trade creates friction. Trading costs. Taxes. Bad timing. Emotional decisions. The more frequently you buy and sell, the harder compounding can work. Patient investors allow businesses to grow. Overtraders keep interrupting the process. Imagine planting a tree and digging it up every month to check the roots. That's essentially what overtrading looks like. The urge to constantly act feels productive. But investing rewards patience far more than activity. Mistake 5. Investing in things you don't understand. This one traps smart people all the time. Using a product doesn't mean you understand the company behind it. Loving a brand isn't the same as understanding its business model. Buffett built his career around something called the circle of competence. The idea is simple. There are businesses you genuinely understand. And there are businesses you don't. Success comes from knowing the difference. Buffett once said the size of your circle doesn't matter. Knowing its boundaries does. In fact, he avoided many technology investments for years because they were outside his expertise. That discipline protected him from disasters. But it also caused him to miss some huge winners. He openly admitted passing on Google was a mistake. He admired the company. Used its services. Saw its success. Yet still didn't understand it deeply enough at the time. And that's okay. Because missing opportunities hurts far less than losing money on something you never understood. Every few years, a new trend captures investors' attention. Cryptocurrency. Artificial intelligence. Biotech. Whatever is making headlines. People rush in without understanding how the businesses actually work. Prices rise. Excitement grows. Then reality arrives. When markets cool down, those who never understood what they owned become the first sellers. The investors who survive are usually the ones who understood the business from the beginning. Mason recently invested in a company he couldn't explain if his favorite pizza depended on it. He knows the ticker symbol. He knows social media loves it. He knows the CEO is called a genius. But he has no idea how the business truly makes money. That's not investing. That's speculation dressed up as investing. Humility keeps you inside your circle. The moment ego takes over, trouble follows. Mistake 6. Anchoring to the price you paid. You buy a stock at $60. A few months later it's trading at $35. Instead of asking whether the business is still worth owning, your brain becomes obsessed with one number, $60. That purchase price turns into an emotional reference point. So you buy more at $35. Then more at $25. Then more at $15. Each purchase feels smarter because the stock looks cheaper. But cheaper doesn't automatically mean valuable. A stock can fall 90% and still be overpriced if the business underneath is falling apart. Buffett's solution is brutally simple. If you're in a hole, stop digging. The money you've already lost shouldn't influence your next decision. The only question that matters is, if I didn't own this today, would I buy it at the current price? If the answer is no, you're holding it for emotional reasons, not rational ones. The market doesn't care what you paid. Your purchase price has zero influence on what happens next. Mistake 7, following the crowd. Human beings are wired to copy other people. For most of history, that helped us survive. In investing, it often destroys wealth. Whenever everyone seems certain about a stock, a sector, or a trend, danger usually isn't far away. Buffett often reminds investors that being popular doesn't make something correct. Facts determine reality, not votes. We saw this during the dot-com bubble. We saw it again during the meme stock frenzy. The pattern never changes. Prices rise. Confidence explodes. Everyone feels like a genius. Then reality arrives. The crowd can convince you to buy, but it will never tell you when to sell. That's why independent thinking matters. Not blindly opposing the crowd. Not blindly following it. Simply making decisions based on facts rather than excitement. Mason learned this the hard way after joining an investing group chat filled with rocket emojis and promises of easy riches. The confidence was endless. The profits weren't. When the hype disappeared, so did most of the people giving advice. Mistake 8, using leverage. This is where intelligent investors often make their biggest mistake. Borrowing money amplifies everything. The gains, the losses, the stress, and sometimes the destruction. Remember the two men from the beginning? The investors who lost billions despite winning Nobel Prizes? Their names were Robert Merton and Myron Scholes. They helped run long-term capital management, one of the most sophisticated investment funds ever created. Their models were brilliant. Their research was world-class. Their downfall was leverage. To increase returns, they borrowed enormous amounts of money. When markets moved against them, small losses became catastrophic ones. Within months, billions vanished. The financial system came dangerously close to a wider crisis. Meanwhile, Warren Buffett watched from the sidelines. No leverage, no panic, no rescue required. That's the danger of borrowed money. A normal investor can survive a market decline. A leveraged investor may not get the chance. Imagine having $10,000 and borrowing another $10,000. Now you're controlling $20,000. A routine 25% market drop reduces that position to $15,000. After repaying the borrowed money, only $5,000 remains. The market fell 25%. Your wealth fell 50%. The investor beside you who didn't borrow simply waits for recovery. You may be forced out before recovery ever arrives. Leverage removes the greatest advantage investors possess: time. Buffett once said that risking what you need for something you don't need is simply foolish. That's exactly what leverage does. It turns patience into pressure. It transforms temporary declines into permanent losses. And history shows that even the smartest people in finance are not immune. If Nobel Prize winners couldn't control leverage, the rest of us should treat it with extreme caution. Now we've reached an important turning point. The next mistakes aren't really about behavior. They're about understanding what a stock actually represents. And that distinction changes everything. Mistake 9, confusing price with value. Most investors know the price of their stocks. Very few know their value. Buffett's entire investing philosophy can be summed up in one sentence. Price is what you pay. Value is what you get. A stock's price reflects emotions, headlines, and market sentiment. Its value comes from the actual business, its earnings, cash flow, and long-term potential. Two companies can trade at the same price while having completely different values. Successful investors focus on what they own. Everyone else focuses on the ticker. Mason knew every stock price in his portfolio. He couldn't explain the value of a single one. That's why markets controlled his emotions instead of the other way around. Mistake 10, selling winners too early. One of the biggest wealth killers sounds responsible. Take profits. A great business rises 50%, then 100%, and investors rush to sell. The problem? Compounding needs time. Buffett's favorite holding period is famously forever. Most wealth isn't created in the early years. It appears later, when compounding accelerates. The investor who sells early collects a small gain. The patient investor collects decades of growth. Mason finally resisted the urge to sell one of his best-performing investments. It was a small decision. But it was the first time he allowed compounding to do its job. Mistake 11, getting diversification wrong. Buffett seems to give two opposite pieces of advice. First, he says over-diversification can dilute your best ideas. Then he tells average investors to simply buy a low-cost S&P 500 index fund. So which is correct? Both. If you deeply understand a handful of businesses, concentration can work. If you don't, and most people don't, broad diversification through an index fund is usually the smarter choice. Even Buffett instructed that most of his family's money should be invested in a low-cost index fund. The real mistake isn't owning too many stocks or too few. It's pretending you know more than you actually do. Mason looked at several stocks he couldn't explain and finally admitted the truth. They weren't investments. They were guesses. So he simplified, moved most of his money into a low-cost index fund, and stopped trying to prove how smart he was. Because investing isn't about impressing people. It's about building wealth. Mistake 12, hiding in cash and ignoring inflation. After hearing about crashes, bubbles, and investing mistakes, many people arrive at the same conclusion. I'll just keep my money in cash. It feels safe. But safety and purchasing power aren't the same thing. The danger isn't that cash suddenly crashes. The danger is that inflation quietly eats away at it year after year. $1 today won't buy what $1 buys 20 years from now. The number in your account may stay the same, but its buying power steadily shrinks. Buffett has called inflation one of the most destructive hidden taxes ever created. And unlike market declines, you won't even notice it happening. That's why long-term wealth isn't built by holding cash. It's built by owning productive assets, businesses, stocks, and investments that grow faster than inflation. Of course, some cash is necessary. Emergency funds belong in cash. Short-term expenses belong in cash. But keeping decades of wealth parked in cash because markets feel scary is a guaranteed way to fall behind. Mason finally realized this. He stopped checking his portfolio every few hours. He kept emergency money where it belonged. Then he invested the rest and gave it time to work. And for the first time, he stopped paying the genius tax. Conclusion. So there they are. The 12 investing mistakes that quietly destroy wealth. Trying to time the market. Paying excessive fees. Letting fear and greed take control. Overtrading. Investing outside your circle of competence. Anchoring to purchase prices. Following the crowd. Using leverage. Confusing price with value. Selling winners too early. Getting diversification wrong. And hiding in cash. Notice what's missing from that list. There's no mistake called not being smart enough. The investors who nearly collapsed the financial system had Nobel Prizes. The investor who became one of the richest people in history focused on patience, discipline, and simplicity. That's the lesson. Successful investing isn't about having a higher IQ. It's about avoiding unnecessary mistakes long enough for compounding to work. As Charlie Munger once said, the secret isn't being very intelligent. It's being consistently not stupid. That's exactly what Warren Buffett spent his entire career doing. And it's exactly what ordinary investors can do too. Mason didn't become a genius. He didn't discover a secret stock. He simply stopped getting in his own way. One decision at a time. And maybe that's the most important lesson in this entire video. The biggest fortunes aren't usually built through dramatic moves. They're built through small, boring, disciplined decisions repeated for decades. The investor who nearly lost everything chased more. The investor who became a legend learned when enough was enough. And surprisingly, the second approach worked a lot better. So the next time markets get noisy, headlines get scary, or everyone around you is convinced they've found the next big thing, remember this. You don't have to outsmart the market. You just have to outlast it. Thanks for watching. I'm Della. And I'll see you in the next one.